Hello, good evening, guys. How are you?
Hello, sir. I'm good, thank you.
Sir, doing good as well, sir. I just wanted to add, sir, I still did not get the notes that we were talking about last week. I don't know how it will be different. I can only see the volume one notes on the platform. So maybe they would kind of sending it directly into our mailbox, or would it take?
And you cannot see the note, right?
No, sir.
Okay. Voice breaks, or if during the talking, if you think that there's some distortion or something, do let me know. And Lavish, I have sent the notes. I have sent the message to the relevant guy at the academy. The message on the WhatsApp, man. I hope you have my number now.
Yes, sir. I got the WhatsApp group.
You got the WhatsApp group today, or you had it before as well? My
No, it's
number.
today. It's today.
Okay, okay. I just texted to the guy at the academy as well. Let me text to Mr. Hamza as well, because this is something I thought that it would be done, sorted. I mean, like, this should have been sorted. I don't know why it's just like this. I'm just texting and then we will resume.
Yes, sir. And I think it will be hard. I'm just lacking behind for 2 or 3 weeks. So it will be hard at a later stage to catch up.
Okay, I just texted, and I hope you guys will get the notes in time now, and you don't have any this issue again. And I hope you won't find any issue. But again, what I will do today is I'll be sending you the notes so that in the future you can access from the portal as well. But for now, that you can have the notes, and then you can easily resume and start your preparation and all. Now let me just open the contents from my side. Yeah, I've got the message. I've got the confirmation message from from the sir as well, and he said definitely going to look into it, that why you guys are not getting the notes and everything. Okay, so it will be done and it will be sorted soon. Okay, let me. I'm just opening the note so that we can just start from there. Okay, last time, as per our discussion, we were going through the fair value model of the non-current assets, in which we talked about the fair value, the fair value model, where we actually report the assets on their fair value. And we did happen to talk about that the fair value is the value at which an asset could be exchanged or a liability settled between the knowledgeable willing parties in an arm's length transaction. And in that area, we talked about having a carrying value of the asset and then a fair value of the asset, and then how do we account for the fair value. And the rule for that was that the date on which the fair value is given, for the sake of comparison regarding the fair value and the carrying value, it is necessary to calculate the carrying value at the exact date, or at the exact same date on which the fair value is given. Only then our comparison is going to be relevant and is going to be accurate. And then we had this example where the cost of the asset was 100,000, the life was 10 years, and after 3 years, the asset was appraised as having a fair value of 90,000. And for this, in step one, what we did, we calculated the carrying value of the asset after the exact 3 years, in which we got the assets carrying value at 70,000. And then we took the difference of the carrying value and the fair value, we got the revaluation gain of 20,000. And then we talked about how to record this fair value into our accounts, or how to record this gain into our accounts. Then we talked and we discussed that this gain is not related to the operations, therefore it cannot go into the income statement. Secondly, this gain is not realized. That is why it cannot be taken to the income statement as well. So we talked about, in order to recognize this gain, what do? We take it and we make it the part of the equity as a revaluation reserve. So what we did, we credited the revaluation gain and we took it to the equity, and the revaluation gain over here in this example was 20,000. And then we debited the accumulated depreciation by 20,000. And we talked about why we are debiting the accumulated depreciation, because depreciation itself is an estimation, and we estimated that the asset will be losing its value by 30,000 in total, at the end of the 3 years, but in actual it lost only the value of by 10,000. So our estimation was wrong, so we reversed the estimation and we debited the accumulated depreciation. So debiting the accumulated depreciation and crediting the revaluation reserve, this is the double entry you pass in the accounts where separately the cost account and the fair value accounts, the cost account and the accumulated depreciations accounts are maintained. But if you are only maintaining the assets carrying value account, in that case, you don't have the accumulated depreciation with you. And in that case, what do? You only debit the asset account, because accumulated depreciation accounts are not maintained. And in that case, you only have the assets carrying value with you. So you only debit the assets carrying value account. See, this is the double entry that the asset is debited and we credit the revaluation gain, right? Now, moving ahead from here, if we compare it with our slide notes, which we were happen to talk about, and let me just share that as well with you. Okay, so this is the subsequent valuation that we had. And in this, we talked about the revaluing the asset, where we are using the revaluation model. We have to revalue the asset regularly. The revaluation gain or the loss is the revalued amount of the asset minus the carrying amount of the asset. That is the previous revaluation minus accumulated depreciation since that date. And then over here, we have an example with us. And if you look into this example and all, the gain on revaluation, this is transferred directly, or transfer the gain directly to a non-distributable revaluation reserve, do not include it into their profits or the reported profits. And the reason being that why do we don't include it into our reported profits is because it is not related to the operation. Secondly, this gain is not realized, and something which is not realized, it cannot be taken to the directly to the profits. And then as far as now the loss on revaluation is concerned, the loss on the revaluation is concerned, now this is something we have to talk about today. And the concept is the loss on revaluation. We are going to report the loss in the in the income statement for the period unless the loss reverses an earlier revaluation gain. Now, this is a statement which we just talked about, that if we have a loss on revaluation, I mean, for example, if the market value of the asset is increased, we record it as a revaluation gain. But the asset's value can decrease in the market as well, right? The asset's value can decrease in the market as well. Then what we are going to do in that case, if the value of the asset is decreasing or has decreased in the market, then we are going to charge the decrease in the value of an asset to the income statement as a revaluation loss, unless or the loss reverses the previously recognized revaluation gain. Now, let's just talk about this statement, and let's just have a look into an example in order to properly understand it. Now, let me share it again with you guys. Okay. Suppose assets cost is life is 10 years, appraised as having a fair value $1,000 at the end of year 3. Now, this is the same previous example which we have just talked about. What we are going to do is 100,000 by 10,000 into 3, we have 1,000 accumulated depreciation. Carrying value of the asset is 100,000 minus 30,000 is 70,000. Fair value is 90,000. Revaluation gain is 20,000. Done. And we have passed double entry as asset debit with 20,000, and we have credited the revaluation gain as 20,000. So this is something which we have already done. So next year, the depreciation charge will be revalued amount divided by remaining useful life. Revalued amount at this time is 90,000. Remaining useful life is 7 years. So we have 90,000 by 7. We have 12,857 as the depreciation charge. Depreciation charge for the year. Now, if we prepare statement of comprehensive extract and statement of financial position extract, what will happen? We will have a depreciation charge of 12,857, and we will have the asset at 90,000 minus 12,857 at 77,143. We will have the asset at its carrying value of 77,143. This is going to be for the year 4. Now, let's assume at the end of year 6, the asset is appraised as having a fair value of 20,000 and no change in the remaining useful life. Now, at the end of year 6, now the asset is appraised as having a fair value of 20,000 and there is no change in the remaining useful life of the asset. Now, this is the extract at year 4. This is the extract at year 4. Now, at the end of year 6, the asset is appraised as having a fair value of 20,000. Now, again, the rule for checking or comparing the fair value is apply the same rule. That is, calculate the carrying value at the exact date on which the fair value is given. We have to calculate the carrying value of the asset on which the fair value is given. Now, year 4 has passed. We have recorded it into our accounts. Now we are talking about at the end of year 6. So technically, we have to take the depreciation for 2 more years, year 5 and year 6, right? For year 5 and year 6, we have to calculate the depreciation. So now the depreciation charge for the year is at 12,857, right? What we are going to do is accumulated depreciation for 2 years will be 12,857 into 2. We have 25,714. We have 25,714. So the carrying value of the asset at the end of year 6 will be 77,143 minus 25,714. We have 51,429. We have 51,429. Now, the fair value is, let's just say we have, I'm just changing a bit of an example. I'm saying the carrying value is at 40,000. For now, let's assume the carrying value is basically 40,000 because I have to make you understand 2 things over here. Okay, now at this instance, the fair value is at 40,000. Okay. Now the fair value is 40,000. The carrying value is at 51,000. So we have a revaluation loss of 51,429 minus 40,000. This is at 11,429. We have a revaluation loss of 11,429. Now, how to record? I mean, if we have a revaluation loss, then how we are going to record it? So the best double entry is going to be, we are going to debit the revaluation loss with 11,429. We are going to credit the asset with 11,429. Done. This is the double entry that we are to pass. We are going to debit the revaluation loss with 11,429 and we are going to credit the asset with 11,429. Done. Now, the revaluation loss will be adjusted against the revaluation reserve already existing in the accounts. The revaluation loss is going to be adjusted against the revaluation reserve that is already existing in the accounts. Now, what was the revaluation reserve already existing in the accounts? If we go back and we look here, we had a revaluation gain of 20,000 with us, which was already recorded into the accounts. We had a revaluation gain of 20,000. which was already existing in the accounts with us. Done. This is already existing, so we are going to record. We are going to adjust this revaluation loss that we have now over here against this 112429. This revaluation loss is now going to be adjusted against that revaluation gain that we had in the past. Done. So now what is going to be the double entry for this? We are going to debit the revaluation reserve with 11,429, and we are going to credit the revaluation loss with 11,429. Done. And this is the basically closing entry at the year end that we are going to pass, because it's a loss now, so we have to transfer it into, like, into the accounts or somewhere where we can basically, like, close it up. So this is the closing entry, and that is the entry that you're going to pass at the end of the year. Now, if I prepare the extracts for the year 6, what will happen? I have this statement of comprehensive income with me. Then I have statement of financial position with me. First thing I am going to have over here is the depreciation charge. And the depreciation was 12,857. 12,857 is the depreciation charge. Then now I have the asset. Asset has been credited by 11,429. Carrying value was 51,429. So technically the asset is going to be reported at the carrying value of 40,000, which is again the fair value for now. Done. And then in the equity, I will have revaluation reserve, and this revaluation reserve is going to be 20,000 minus 11,429. I'm just showing that this calculation for your understanding basically, but let's just move it to here and have the figure over here. So 20,000 minus 11,429, we have 8,571. So this is how basically we are going to report into our accounts if we have a revaluation loss, and that revaluation loss has already a revaluation gain existing in the accounts against which we can adjust it. Now, point to remember, this adjustment or this accounting treatment is done in only that case where the asset is devalued in the market. Devalued means its value has decreased in the market, or its revaluation value has, or its fair value has decreased in the market. This is the adjustment we are going to do only in the case if that particular asset had a revaluation gain already into the accounts. If the revaluation gain is existing in the accounts but is not related to this asset, then you cannot do this entry and you cannot do this adjustment. The revaluation reserve has to be related to the same asset which is basically devalued or whose value is basically decreased in the market. For example, you have a revaluation reserve related to the land and building, and the value of your plant has decreased in the market. You cannot do this entry, you cannot do this adjustment against the revaluation of the land and building, against the plant's devaluation or the plant's value. You cannot do that. If the land building's value decreases, you already have a revaluation related to the land building, you can do the adjustment. But if the revaluation reserve is not related to the particular asset which has been devalued, you cannot do this adjustment. Then you will have to take it straight away to the income statement. Same case. Assuming no revaluation assuming no revaluation reserve was existing in the accounts. Assuming no revaluation reserve. Okay, I repeated the word. Okay, no, assuming no revaluation reserve was existing in the accounts, then the simple double entry would have been debit statement of comprehensive income with the loss, this 11,429, and we would have credited the asset with 11,429, and this 11,429 would have been straight away gone to the income statement as a statement of comprehensive income, and it would have been charged as a revaluation loss. It would have been charged, it would have been minus, it would have been deducted, it would have been debited into the statement of comprehensive income as a revaluation loss. Now, situation 3. Fair value of the asset is 20,000. Now, I'm assuming the fair value of the asset is 20,000. Carrying value is, I have calculated the carrying value, and carrying value is 51,429. Right? And revaluation reserve existing in the accounts related to this particular asset is 20,000. Then, now, situation 3 is the fair value of the asset is 20,000. The carrying value of the asset, which we have already calculated, is 51,429. And the revaluation reserve, which is existing in the accounts related to this particular asset, is 20,000. Now, what is going to happen and how we are going to record our, as far as the adjustments are concerned. Step 1, calculate the revaluation loss. That is carrying value minus fair value. Carrying value is 51,429 minus fair value is 20,000. So the revaluation loss is 31. Yeah, 31,429. Done. So the revaluation loss is 31,429. Step 2, recording. We are going to have a debit, then we are going to have a credit entry. The credit entry is technically going to be again of the asset. We have to reduce the value of the asset. Done. So the asset is going to be credited. Now, what to debit? First of all, we are going to debit revaluation reserve. The whole of the revaluation reserve is going to be reversed. The whole of the revaluation reserve is going to be reversed, and that is 20,000. And then if any balance remains, it will go to statement of comprehensive income as a balancing figure. And this is going to be 11,429. Done. This is going to be 11,429. And this entry is going to be done only in the situation, only in the way, or only in the case where we had a revaluation reserve related to the asset. The asset got devalued in the market, and after its devaluation and all, now we have to record its devaluation. The rule is, first of all of the revaluation reserve is going to be reversed, and if any balance remains, it will be charged to the statement of comprehensive income as a loss on revaluation or a revaluation loss, right? Or a revaluation, like we have the revaluation gain, we are going to record it as a revaluation loss. Now, I am strictly following one rule. Whenever I'm saying I'm saying this is a revaluation loss, this is a revaluation loss. I could have easily said the asset has impaired. Revaluation loss and impairment, these are the two different things. Okay, these are two different things. Let's just not mix them over here. We are going to talk about, we are going to study the standard of the impairment as well. Okay, but revaluation loss and impairment, there's a bit of a difference between them, so that's why I did not classify it, I did not call it as an impairment. Although as if the asset is impaired and that particular asset has the revaluation reserve already existing in the accounts, the same treatment will be done. The asset which is impaired, impairment means decrease in the value of an asset due to some other reasons apart from its usage. The decrease in the value of an asset apart from its usage or the reasons other than its use, it is called impairment, right? And the decrease in the value of an asset due to its usage, it's called depreciation. Done. So depreciation is basically decrease in the value of an asset due to its use, it's called impairment. And the decrease in the value of an asset due to some other reason or something apart from its usage, it's called impairment. Done. The first one is the depreciation, the other one is the impairment. And we are talking about the revaluations basically. And if the revaluation loss is basically because of the impairment or something, then we are going to then we are going to call it as impairment loss. But if there is no situation which is being given to us regarding the impairment or something, if there is no situation which is telling us about the impairment or something, then we are going to call it as a revaluation loss. I mean, this is a simple rule of the accounts, or this is a simple rule of the accounting standards, basically, which we are following. Uh, the main crux which I want to tell you is that if in the question it is stated in a scenario that the asset has impaired, or because of the impairment the asset's market value has decreased, or the market value of that asset has been decreased due to a legislation, due to a bad publicity, or due to some factor, the factor is being stated in the question, the factor or the reason is basically stated in the question because of which the asset's value has decreased, then you are going to treat it as an impairment. But if it's only written in the accounts or in the question that the asset had a fair value of this at the year end, that's it. No other information is whatsoever is given to you. If it's only that the asset's fair value at the year end is itna, I mean, they have just given you the amount or something. That's it. And it has not, like, told you about. It's not telling anything about that why the asset's value has decreased or something. There's no situation whatsoever into the question. Then in that case, you are going to treat it as a revaluation loss. But if it states that because of a legislation, because of a bad publicity, because of a damage into the asset or something, the asset's value has decreased, then in that case, it will be regarded as an impairment. Done. This is the simple rule, basically. This is the thin line difference which is over there between the revaluation loss and the impairment. Although the treatment is same, the concept is same as well, but it's just a way of, like, naming two different things as like, two different names. I mean, this is something like, the rule has been made. Long story short, it's just a rule that you have to think about. You just have to keep in your mind regarding, like, when you have to talk about these adjustments. Done. So this is what we have just talked about, and this is what basically we have treated as far as, like, the loss is concerned, or where we basically have to account for the loss is concerned. Okay, moving ahead from here. Now this is the line which we did happen to talk about, and this is the line which we just discussed into a whole lengthy example which we just talked about. Okay, moving ahead, we have an example over here. We did happen to talk about the example, the revaluation loss, the revaluation, this everything is basically recorded over here. You will have these slides as well, and I'm going to make sure that by my 12 a.m. I'll make sure that you have the notes. Even if I have to send them onto the WhatsApp group, which is now created, I'll be sending onto the WhatsApp group as well. But again, I will make sure again that from tomorrow onwards, you have each and everything on the portal as well. Now the WhatsApp group is created, and this is Lavish. I have you. Yeah, Lavish. One thing you have to make sure over here is if there is any ambiguity, if there is any delay as far as the notes being getting uploaded or something, you just have to just drop me a text. Okay, you just
Yes, sir.
have to drop me a text, and I'll make sure that this time onwards you don't find any difficulty or something. Okay.
Yes.
Okay, we have two more students with us today. One is Miss Sophie and one is Arshad, if I'm not wrong. I'm pronouncing your name correct. Welcome to the class, guys. This is our third lecture, if I'm not wrong. And we have everything. We have the recorded lectures on the portal as well. We have the notes and everything onto the portal as well. So you won't be having any difficulty or something. But again, the WhatsApp group is created. If you find any difficulty or something, okay. Okay, Miss Sophie, you're here since first class. Okay, my bad. Maybe I just happened to see your name today for the first time, maybe. Or is it Miss Wudushi? But someone is over here for the first time. I'm like two students are over here for the first time. I'm not sure because this is something I've been remembering. We had two students, if I'm not wrong. Is like is Miss Wudushi has joined for the first time?
Yes, it's the first time today. Yes.
Okay, okay. But Miss Wudushi, if I'm not wrong, did you happen to take the class before from me as well?
Yes. Last year, I was supposed to take exam December, but I could not take exams December. I had to drop classes in between.
Okay, you dropped the
Yeah.
classes in between. Yeah,
Yeah.
because I was just thinking about your name, and when I just happened to see your name, I was just thinking kind of because I thought maybe this is another student or something, but I had in my mind that maybe you were in
No,
the
it's
class.
me. It's me actually.
Okay, okay, okay. Anyhow, welcome back, and I
Thank
hope
you.
this time we will get through the exams as
Yes.
well,
Yes.
and this time it
Okay.
will be possible for you to give the
Yeah.
exams.
Yeah.
Anyhow,
I just
welcome to
hope
the
everything
class
goes
again.
right.
Yeah, no problems, no problems. Welcome to the class, and we
Thank
have the
you.
same rules. Everything is uploaded. You have the access to the
Yeah.
WhatsApp group as well, so everything is kind of clear to you. I don't have to repeat each and everything because I know
Yes.
you are familiar with the
Yes.
process and everything, and
Yeah.
this is something you will be getting along. And then we have one more student that is I'm not sure if I'm pronouncing it correct. It's Arshad, right?
Yes.
Okay, okay. Welcome to the class, boy. And you are working as well.
Yes.
And what do you work? I mean, what's your job?
Auditing firm.
Mm-hmm. And what are the papers you are opting for this time?
F7.
Only.
Yes.
Okay, okay. And this is the first time, or you have already studied F7?
I have already attempted twice, but
Okay,
I did not pass correctly.
okay, okay. No problems, no problems. Ashad, I'll be kind of honest with you.
Yes.
I don't want to blow my own trumpet or something, but this is something I have a blessing from God or something, but I don't know. This is something I've been this is something I've been good at, maybe that somehow, some way, I'm kind of able to get my pass those particularly students of mine who are unable to pass in the first attempt or something. So you don't have to discard or something. You don't have to get your morale down or something. You have to make one commitment with me today, and I'll be making two commitments with you today. The commitment is basically you have to take 1 hour daily out of your schedule for this F7. 1 hour daily,
Yes.
right? 7 days a week, you are going to give only 1 hour daily, not more than that. If you are able to get free in like 10 minutes or so, close your books and you are good to go, right? And if you are
Yeah.
studying and the 1 hour is completed, believe me, close your books and go. I can bet on that. If you're able to give 1 hour religiously to your subject, to this subject, I
Yes.
can literally write it on a piece of a paper that I can guarantee you that you will be able to pass your paper. I mean, I've been through the ACCA as well, and for me, basically, it was the law paper, the F4. I attempted it twice, and I got failed. And it was my third attempt in which basically I passed that paper. This is the only paper, the law paper, I had the issues as far as being a student is concerned. Although I was very good at it. First time I attempted the paper, and I attempted the 100% of the paper, and I thought that at least I'll be able to get around 75 to 80% marks. But when the result came, I had 48. The next time I attempted the paper, again 100%.
Yeah.
And this time I was kind of thinking to get around around 75 to 80 again, because according to me the paper was fine and it was very good. And then I failed again at 46. And then third time I kind of changed my approach. My teacher guided me, and I kind of changed my approach and towards as far as the solving the paper was concerned. And I had a very hard time studying for the third time. And then when I gave the paper, I said, go to hell. If it has to pass, it will pass. If it has not to pass, then let's just leave it as it is. And believe me, when the result came, I had 73 marks. And the third time, the difficulty which I had, or the difficulty which I faced as far as while preparing for the paper was concerned, because I had already attempted it twice. It was the third time. Whenever I used to open the book, I used to remember the case laws, the name of the cases, everything by heart. I knew what was the case law, what was the precedent, what was the contract, and I mean the points of the laws paper basically which we have. So what happens when we study for the second or the third time? Whenever we open the book or whenever we open the notes, we are like with the approach that, okay, I already know this, I've already done this, I know the answer of this, I know how to solve this. Okay, I didn't know how to do this last time as well, so I won't be knowing how to do this last time as well, this time as well. So this is the approach which basically brings a problem for us. This is the approach which brings the problem for us when we say, or when we start thinking that this is something we have already done, or this is something which cannot be done this time as well, because from the last two times I have not been able to do this. So this is something you have to kill and you have to overcome, right? Because definitely for sure, when you're going to open the stuff, I know, from my experience, basically, when we have done the stuff now, so technically, for the second or the third time, we kind of come across the problems as in the sense we are unable to do, we are unable to practice properly as well, because we always think, or we start thinking that I've already done that, I'm already good at this, or I'll be able to do this. So this is something all of you guys have to overcome, right? You guys have to overcome. So I'll be following both the exam kits. Technically, the BPV one is basically the official one, which we will be following in the class. But I have already given the Kaplan exam kit as well. That Kaplan exam kit, you guys will be doing it at your home. And obviously, any problem, any question that you have into the Kaplan or even into the BPP as well, we will be religiously discussing them into the class as well. There's no point, there is no area of the syllabus which we are not going to discuss, which we are not going to do the practice of. There will be a comprehensive practice and a comprehensive approach towards the paper at the end of the day, which is going to get us through through the end basically. And this is something, again, I don't want to praise myself or something. Recently my students from the academy, I mean from the Mauritius, basically they gave the paper, and thanks god, it's all about their effort and everything. All of them passed, the paper. So this is something I expect from all four of you for now as well. Technically we have a bit one or more two more students with us, and technically they have not joined yet. I mean today as well. But this is something I hope from all four of you as well, that definitely for sure this time you guys are going to pass the paper as well. Anyhow, coming back, We just talked about the example of the gain on the revaluation and the loss as well. Moving ahead from here, we have this depreciation, which we have already talked about. We have made the accounts as well. We have talked about the straight line method. We have talked about the reducing balance method as well. This is already discussed. Then we have another additional point with us, and that is basically as far as the understanding of the standard is concerned. This point is basically related to as far as the understanding of the standard is concerned. This is not something which I kind of see be example or basically, and that is the change of the depreciation method. Depreciation is an estimation. Estimation. One thing is for sure: accounting estimates, accounting policies, and the prior period errors. We are going to discuss that standard as well later in coming classes. But for now, let me tell you one thing: the estimate is a professional judgment being done by the accountants while the preparation of the accounting, the accounts or the financial statements. And whenever there's a change of an estimate, the change of an estimate is simply applied from the current period onwards. This is a perspective change. From now onwards, this is a perspective change, or that is the change which we apply from the current period to the coming period. So whenever there is a change of depreciation method, there is a change of the useful life of the asset, there is a change of the percentage of the depreciation as well. This change is not going to affect any of the previous records. This change is not going to affect any of the previous records. All you have to do is apply the change in the current year and move forward. You don't have to do any extra adjustments. You don't have to do any extra disclosures or something, right? All you have to do is you have to make a disclosure into the notes of the accounts, and you just have to tell about that. This is the change which we have incorporated, and this is the change in the estimate which we believe is going to be a proper representation regarding the value of the asset. This is what you have to do. I mean, if there's a change in the revision of the useful life, if there is a change as far as the percentage of the depreciation is concerned, you are simply going to apply it into the the current year, basically, the accounts which you are preparing. Then moving ahead, we had the change of estimated life. This is something already discussed. And then we have this, the gain on the loss and disposal. For this, let me share one thing again with you, which I did happen to share with you last time as well. Okay. Just give me a second. Let me open my Excel basically. Okay. We did happen to talk about these accounts. So we did happen to talk about these accounts, and as far as the slides are concerned, the PowerPoint slides which I had opened right in front of you, it contained regarding the gain and loss on disposal. So this is the disposal account which we have already created. And as far as these accounts are concerned, you will be needing these accounts as far as is concerned. And if in that section you come across a question related to the cash flows, if the question is related to the cash flows and you have to prepare the extracts of the cash flows, and then in that case you are going to use these four or any of three created in the case where the cost and the cumulative depreciation accounts are not maintained separately, where the accumulated depreciation cost accounts are not maintained separately, we use the carrying value account, right? And this is the disposal account, which is going to give us the profit or the loss on the disposal. So this is the account which we have already talked about in detail, and we have already prepared these accounts in detail, and we have we did happen to have a very detailed discussion about this. which you can come across, and you can see into the recorded lecture as well. Done. So this is something you guys are supposed to see from there. Now, moving back, I just wanted to make sure, I just wanted to show you guys that this is something we have already discussed and it's already done. Okay. Now, as far as the disclosure is concerned, we are technically the disclosures as far as are concerned, we normally report what's the depreciation charge, what's the carrying value of the asset at the end of the year, and then everything is kind of as far as the disclosures are concerned, they are as far as the stage of the F7 is concerned, the values which we report into our accounts are kinda going to be our disclosures. Now, moving ahead, which I wanted to talk about, the government grants. This is IAS 20, the government grants, one of the interesting standards. And as far as the testing is concerned, you can have a question or two in section A. As far as the section C is concerned, the testing of this section is, or this standard is rare. And as far as the section B is concerned, the examiner can have a full-fledged one, the scenario-based question where it can talk about the government grants. Okay. Now, talking about the grant is a favor, right? The grant is a favor, in literal meaning. If we talk about what's a grant, grant is basically a favor. Talking about the government grant in the context of the accounting. In many countries, the government gives cash grants to the business entities in order to encourage investments, right? For example, a government might give companies a cash grant towards cost of investing in a poor region of the country, or in a particular industry, or for spending on particular activities such as scientific research, right? For example, if I talk about my country, there is a city called as the Gwadar. Gwadar is the name of a city, basically. So over here in Pakistan, the government has announced that whoever goes to Gwadar, set up their business over there, they will be tax-free for the coming 20 years. So this is a grant being offered by the government, that if you go to a particular city and you set up your business over there, you set up your factory over there, your earnings will be tax-free for the coming 20 years. Now, why the government is offering this, this whole situation, or why the government is offering the tax-free for or the favor, why the government is offering this? So that a particular area or the particular class of people of those areas can flourish, right? If the government wants to have a spending, into a specific region or into a specific sector as well, the government can offer, the favors in those or in that particular area or something. Like if we talk about IS 20, basically, IS 20 basically specifies how the government grant should be accounted for, basically, right? Now, there is basically, let me tell you in advance, there is a grant of two types. So basically we can say, not the grant, but the favors are of two types. One is called a grant, one is called an assistance. Grant is basically given to a particular industry, to a particular class, or to the grant is related to particular expense, right? When the favor being given by the government is related to particular class, people, sector, industry, or expense, it is going to be called as a grant. But when the favor is given by the government to the general public at large, when the favor is given to the general public at large, it's called a government assistance. It's called a government assistance. Now, assistance is something which is given by the government to the general public at large, and grant which is given to the specific industry or the class. I mean, talking about the government assistance, for example, if the government starts giving the subsidy on the petrol, if the government starts giving the subsidy on the petrol prices or on the electricity bills, we call it as a government assistance, because general public at large is using the petrol, general public at large is basically using the electricity. So the favor is given to everybody, to every class, not to a particular one. It's given to a particular it's not given to a particular class of people, it's given to the everyone. For example, I mean, talking about, we can fit this example into the assistance as well. Like the COVID came, right? The COVID came, and then what happened basically? Like, there was a lockdown everywhere. Then, with the help of the WHO and some, like, big companies and all, we were able to come across, or we were able to, like, make up a, like, vaccination basically, or a vaccine. Now, what happened? Somehow, some way, from some, like, companies or something, the countries did happen to get the vaccinations for free. Somehow, some way, from certain companies, the countries were able to get the vaccinations for free, but some vaccinations were bought by the countries as well. And the vaccinations which were bought by the country were also given to the general public for free. The vaccination, I mean, I've got my 2 vaccinations, and then I've got one, my, like, booster shot as well done. And as far as I remember, my 2 shots were of Sinovac, and then I got the booster shot of Pfizer, right? I got 3 vaccinations. Similarly, everyone in my family got the, like, the COVID vaccination and all. And all of us got it for free from the government. Now, in your country as well, you guys must be getting the vaccination for free as well, right? I don't think so. You guys must be, like, paying it for something, right? Now, this is a sort of a government assistance favor being given to the general public at large. There's no discrimination or something, right? Everyone, like, can easily go and get the vaccination, right? If you are, like, fitting into a certain age group or something, right? You can go and you can get the vaccination. This is the best example, like, from the current scenario, if you can say, that is the best example of the assistance that is available to everyone. There is no accounting treatment as far as the government assistance is concerned. We don't do any accounting for that. Now, coming towards the grants. The grants are the favor given to a particular industry or a particular people or to a particular class or to a particular sector, right? Now, there are 2 types of grants. One is a grant related to assets. One is a grant related to income. That is a grant, like, that is not relating to an asset or something. Now, grants relating to assets are the grants that are given to companies to help with the purchase of a specific non-current asset, such as factory. Now, the payment of the grant may be dependent upon the company meeting certain conditions, right? Such as locating the asset in a particular region of the country, right? For example, if your government wants to boost up the car industry, if your government wants to boost up the car industry, it starts giving the grants related to the factories where the cars are being manufactured, right? So this is a grant related to the asset that you have to, like, set up a factory, right? Now, it can be a case that where you have to go and you have to set up the factory into a particular region as well, right? And they are the grants which are related to the incomes, technically the ones which are not related to the assets. And talking about the grants, they should only be recorded, or they should only be recognized in the financial statements if they have been paid, or if it is reasonably certain that the grant will be paid and the grant will be received, right? For example, let's just take a look at the example. Okay, first let's just talk about the grant related to the income. Two methods of accounting for grants related to income. One method is to include the grant in the income and then subtract the grant from the expenses to which the grant relates. For example, the grant relates to income are reported in the income statement, obviously, in the period for the period to which they relate. And obviously, as these are the income, so they are added to the profit for the period. And there are two ways of accounting for the grants related to the income. One is to treat the grant as an addition to income, and the other one is to basically subtract the grant from the expenses to which the grant relates. And obviously, both the methods are going to have the same effect. And technically speaking, profit is increased immediately about regarding to the amount of the grant which has been received. For example, a company spends 300,000 on research in year one. The government pays a grant of 50,000 toward these costs. Now, method one, additional income in year one, you can record the grant as 50,000 as an income. You can record the research expenditure as 300,000. Or method two, research expenditure 300 minus 50, and that is at 250,000. You have the option. You can either record the grant related to the expenses related to the income as a separate entry, or you can net it off with the related expense to which basically the grant relates. It's your choice. However you see fit, you can apply this particular approach. Okay, then we have the grants related to assets. Now, talking about the grants related to asset, technically speaking, uh, the grant related to asset is basically related to the cost of the asset which we have basically just bought. And again, we have two methods where we record the grant separately, and the other one is where we net off the grant from the cost of the asset. We have two methods. One is where we can net off the grant from the assets cost, and one is the method where we can record the grant separately. For example, if we look over here, we have the cost of the asset before grant is 500,000, estimated life is 5 years, residual value is 0. We have the straight line depreciation. And over here, if you see, we have a government grant of 200,000 is received. We received 200,000 of the grant. Method one, we have cost of asset at 500 minus 200. We are netting off the grant from here. So technically, we have the net cost of the asset at 300,000. The annual depreciation is 60,000. Why? Because 300,000 by 5. So technically, we are going to have the annual depreciation of 60,000. The other method is we are going to record the cost of the asset at 500,000, and then what the grant which we have received is going to be recorded as a deferred income. It will be recorded as a deferred income, and it will be treated as a liability. And because this is an income in advance, so this is going to be treated as a liability, and this 200,000 will be recorded into the non-current liabilities. Then we have the annual depreciation. Annual depreciation, how we are going to charge, that is on the cost of the asset. This is 500,000 by 5. We have 100,000. And then we have, as far as the deferred income is concerned, 200,000 by 5. we have this at 40,000. So this is the annual transfer to of the deferred income, and this is going to be at 40,000. And then net cost and income statement is going to be at 60,000. Done. I hope it's clear to you guys. Ms. Sophie, if we deduct the government grant from the cost of the asset, if we deduct the government grant from the cost of the asset, then it is going to be recorded at 300,000. Then if it deducted from the assets cost, then it is going to be recorded at 300,000. But if we record it separately, then in that case, the asset is recorded at 500,000. We don't record it at 300,000. In method one, if we deduct it from the assets cost, then it is recorded at the net amount. And normally speaking, although the two methods are allowed by the standard, but practically speaking, and for the sake of the presentation of the accounts, it is always recommended to record the grant separately. It's recommended to record the grant separately because technically speaking, when the government gives you the grant, obviously the government expects you to do some action in return related to the grant. The government expects some action from you to do in return. Obviously, it's not how, or it's not that simple that you're going to get the grant and that's it. The government is expecting something in return. That's in case if the government is giving you the grant related to the asset, the government expects you to use the asset for a particular time period. And if you breach the conditions related to the grant, if you breach the conditions related to the grant, then in that case, the grant in full, the grant in full is repayable to the government. That if you breach the conditions of the grant, now you have to repay the grant to the government. You have to return the money that you have taken from the government. And the total amount is repayable. It's not that we are going to have some pro rata or something, we are going to have a proportionate method or something. No, we are going to repay the grant in full to the government. So technically speaking, if we have netted off from the assets cost, then in that case, the accounting for the grant is a bit difficult. Then accounting for grant is a bit difficult. So that is why normally, practically speaking, we normally record the grant separately. Now let's just go to our Word file and let's have an example related to a government grant. Okay. Just give me a second. I just have to close some extra pages and all. Okay. So let's just talk about this. Asset cost is 100,000. Life is 10 years. Government gives a grant of 30,000 conditional upon that the asset will be used. Conditional upon that the asset will be used over its total useful life. Now, the government gives a grant of 30,000 on the asset, having a value of 100,000. The grant which has been given is, or which has been granted, is basically 30,000, and the condition is basically that the asset will be used over its total useful life, a total life of 10 years basically. Guys, just hold on for a second please. I just need a second. Okay, so I'm sorry, guys, you had to wait. Okay, so we were talking about assets cost is 100,000, the life is 10 years, and the government gives a grant of 30,000, conditional upon the asset will be used over its total useful life. Now, how the working will be done? Uh, Assuming the grant is recorded separately. We are going to debit the asset with 100,000. We are going to credit the cash with 100,000. And then as we have received the grant, we are going to debit the cash with 30,000 and we are going to credit the deferred income as 30,000. Done. Now, if on the spot we prepare an extract of statement of financial position, we can see that under the non-current asset, the asset is recorded at 100,000. Then in non-current liabilities, deferred income is recorded at 30,000. At the end of year one, depreciation charge on the asset is 100,000 by 10 is 10,000. Then similarly, the grant will be recognized over the useful life of the asset, and that is 30,000 by 10 is 3,000 per year. Now, extract of statement of comprehensive income. We have a depreciation charge of 10,000. We have grant income of 3,000. Then we have extract of statement of financial position. We have asset at 90,000. Then in non-current liabilities, we have deferred grant, and the total was 30. Now, in non-current liability, we are going to record it at 24,000. Then in deferred income, we can say current liability, we have deferred income as 3,000. We are going to split the liability between the current and the non-current section. This is how it is going to be recorded. Now, assuming the asset is sold at the end of year 5 and now whole of the grant is repayable to the government. Show the extract of financial statements at the end of year 5. Yeah, Miss Sophie, but I have the deferred income. I have splitted the liability between the portion of the current and the non-current now. The deferred income is 27 and the 3 is going to be recorded into the next next 12 months. Now, I've splitted the liability portion over here. So that's what 24 plus 3 is 27. Now, assuming the asset is sold at the end of year 5, now the whole of the grant is repayable to the government. Show the extract of the financial statements at the end of year 5. Now, as the asset has been sold, so now the whole of the grant is repayable of the government. What will we do? First of all, we will have to calculate Step 1, check how much of the grant has already been recorded in the statement of comprehensive income, and that is 3,000 into 5 is 15,000. Balance of grant in statement of financial position is 15,000. So 15,000 has been already recorded into the statement of comprehensive income, and the balance is basically at 15,000 into the statement of financial position. Now, what will happen? We are going to debit income statement with 15,000, that is the reversal of grant already recorded. We are going to debit the income statement. The whole of the grant will be reversed now, which we had recorded previously as our income. It is going to be reversed. Then, this is the grant which is going to be reversed. Then we are going to debit the deferred grant with 15,000, and then we are going to credit grant repayable at 30,000. And this grant repayable is going to be our current liability. This is going to be our current liability, which we have to record or which we have to see over here. Done. This is going to be our current liability. Done. I hope it's clear to you guys. Okay, so I hope this is clear. So this is how basically in the case of where we have to repay the grant, or the grant is basically repayable, this is how basically the recordings are done. Done. Okay, moving ahead. So this is basically the treatment of the government grant, which we basically have to do. Now, moving ahead from here, now let's just talk about our slides. Let's just go back over there. And here we go. Okay. So this is the grant related to the assets. Moving ahead from here, now we have IAS 40 with us. And IAS 40 is basically of the investment property. And this is again one of the interesting standards. And talking about this, investment property is the property that is held for rental income, or that is to property that is held to profit from an increase in its market value, or both. That is going to be called as the investment property. Long story cut short, this standard deals with the investments being done into the real estate. This whole standard deals with the investment done in the real estate, right? That is going to be called as the investment property. For example, the property that is used to rental income, or that is held to make a profit from the increase in the market value, is going to be called as, or is going to be treated as, an investment property. It might be an entire property, land, entire be a part of a building, for example, a flat or something, right? And the holder of the investment property will be its owner, or someone else holding the property under the right of use asset. For example, the asset under the lease. For example, if you have acquired the asset under the lease and you are paying the lease rentals and you have the right to use the asset or something, so that is going to be regarded as, or that is going to be recorded as, your investment property. Similarly, if you are the owner of the asset, so technically speaking, that is going to be called as your investment property. And the IAS 40, basically the accounting standard on the investment property, states that the investment property should be stated initially at its initial value, right? That is the cost plus the transaction cost to acquire the property, for example, the professional fees, right? For example, the transaction cost, for example, the transfer fees or something, such as the fees of the surveyor, architect, lawyers, or something, whatever the cost that you have incurred as far as acquiring the property is concerned, that is going to be included in its initial value. Then we have the subsequent valuation. Use either the cost model or the fair valuation model, and that is subsequent. Obviously speaking, we just have to evaluate using any of the two models. One is the cost model. One is the the fair valuation model of the non-current asset. That is the same model which we have studied into the IAS 16. Now, fair value to the model for investment properties, revalue all investment property to fair value each year. There will be a gain or loss in revaluation, which must be reported in the income statement, right? This is going to be recorded in the income statement, right? Now, in the context of the fair value model, this is the difference between the IAS 16 and the IAS 40. In IAS 40, as an investment property, the gain or revaluation is straight away recorded into the income statement because we are holding this property for the sake of the gain. We are holding this property for the sake of gain. And normally into the fair value model, we normally don't charge the depreciation. What we do, we simply check whatever the value of the property is in the market, we do its comparison, and the difference is recorded as a gain or on the investment or the investment property. Now, for example, if you look over here, we have the investment property initial value at 1st January. This is at 3 million. Then revalued at the end of the year is at its revalued or its fair value is at 3.4 million. So the gain on revaluation in year one, which is recorded into the income statement, is at 0.4 million. Done. So the asset in the balance sheet at the end of year one is at 3.4 million. Similarly, at the end of year two, the new revaluation is at 3.7. We have already recorded at 3.4. So the gain on revaluation, which will be recorded into the income statement, is 0.3 million. So the asset in the balance sheet at the end of the year two is going to be at 3.7 million. Then disposal of investment property. If we have the cost model with us, the net disposal value, then selling amount. Gain or loss in disposal is going to be the net disposal value minus the carrying amount. Now we have the word net disposal value. Net disposal value means the cash proceeds minus any fees which you have to pay to the agent or something, a commission or something for the sale and all. This is going to be recorded as a net disposal value. Done. And basically net disposal value and the carrying value is basically the difference between the carrying amount and the proceeds which we have got from the asset, and that is going to be recorded as our gain or loss in disposal. And in the cost model, what do? We basically record the asset at its carrying value. That is, we charge the depreciation on the asset if we are using the cost model. Then as far as the fair value model is concerned, we have the net disposal value, we have the carrying amount over here. Carrying amount is basically logically speaking is the fair value of the asset, and the difference between these two is basically the gain or loss on disposal. Then we have, as far as the transfer of investment property is concerned, and that is a property may be reclassified from one category of non-current asset to investment property, or from investment property to a different category of asset. To account for the transfer, use the fair value of the property at the date of transfer. Now, talking about the transfer of the property, basically this is something where we have a non-current asset or building or a property, real estate property rather. And at first we have classified it as a non-current asset, and we are using it for the sake of like, we are using it on our own for the use into the business or something, and then we just plan it to transfer it to the investment property. For example, if we are no longer using it or something, and if we have an investment property and then we start using it for our own, then this is the transfer of the property between the category of the assets, basically, or the category of the standards rather. And for this, the standard says that you have to use the fair value of the property at the transfer date. For example, asset and the cost of construction is valued at cost to completion at 4 million. On completion, reclassify as investment property. Fair value of this date, the new asset value is 6 million. Gain on reclassification, that is the income statement, it will go as a 2 million as a, like, the gain, and it is going to be recorded into the income statement. So this is a simple transfer of the assets between the categories, basically, where you are either, like, valuing it as investment property, you start using it on your own, then you have to reclassify it from the investment property to the actual, basically, like, the asset, and then from the actual asset, if you're transferring it to the investment property, so you have to do it at the fair values. Then, as far as the disclosures are concerned, we have the fair value model and the cost model. As far as the disclosure of the investment property is concerned, obviously we have to tell about which model is used, and the amounts in the income statement related to the rental income and the related expenses, obviously, as well. And then the details of the contractual obligations to purchase or construct investment properties and for repairs and maintenance of the investment properties. These are the ones, basically, like, we have to record or we have to show, basically. And talking about this, basically, IS 40, it specifies the disclosures that should be made in the notes to the accounts, basically, as far as concerned. And this nature of disclosures, basically, it's going to differ between the properties valued by the cost model, and the values or the properties which are valued by the fair value model. Obviously, there's going to be a bit of a difference between them. If you talk about the cost model, we are going to tell about, like, the depreciation method used, what depreciation method we have used, also the useful life, the depreciation rate. And similarly, like, into the cost model, if we are using or talking about the residual value or something, we are going to talk about it over here as well. Then obviously we are going to show the reconciliation, that what was the balance at the start of the year, what is the current year depreciation, and what is the balance at the end of the year. And again, we are going to disclose, like, while using the cost model, that what is the fair value of the asset in the market. Although we are not going to use it as far as, like, reporting it into the accounts is concerned, but as far as the notes to the accounts is concerned, we are going to disclose that what is the value of our asset in the market, that is the fair value. Done. And then, as far as the fair value model is concerned, we are going to, this is repeating. Okay. Then, as far as the disclosure requirements for the properties being, like, valued at the fair value is concerned, basically, we are going to show the methods, obviously, and then the assumptions which we have used to arrive at the fair value. We are going to, like, talk about those assumptions as well, how we kind of calculated the fair value. Like, if we got the value from an independent surveyor or something, we have to disclose that as well. And then the extent to which the valuations are based on the opinion of an independent and qualified person, we are going to talk about that as well. And this is the reconciliation, that obviously at the beginning of the year, how many properties we had, and then what were the additions during the year, then what are the held for sale. If we, for example, if we are selling some property or something, we have to show that. What are the gain or the losses of the fair valuation of the assets, and then like, if there is any addition through the business acquisition as well. So basically, this is a whole, like, reconciliation statement that we have to show into our notes to the accounts if there is any addition or something related to the investment property. So this is the standard that we had to talk about as far as the non-current assets are concerned. Now, let me just open my exam kit so that we are good to go. Some questions from the exam kit related to as far as our non-current assets are concerned. Let me just open and then we will resume. Okay, just give me a minute and we will. Okay. As far as the tangible non-current assets is concerned, as per our previous discussion and the classes, we have already done the 24, 25, and we have done the 26 as well. Now this is question 27. This is question 27, which is basically relating to the investment property, which we just have to talk about and which we just discussed. Now let's just see this question. Which of the following would be recognized as an investment property under IAS 40 investment property in the consolidated financial statements of build company? Okay, this question is basically related to the consolidation. I'm assuming the F3 financial accounting you guys have studied and you guys have passed, and I hope you guys would have done the consolidation in your paper financial accounting one, and you are kind of remembering a bit of the concepts related to the consolidations. Okay, now we have to apply the concept of the investment property onto this. A property intended for sale in the ordinary course of a business. What's that? The property intended for sale in the ordinary course of a business is normally property that we kind of can say or we can call is basically our inventory, right? And if it's in a ordinary course of the business is something that is a property that we are constructing for the others, or we have it for held for sale or something, obviously it is going to be recorded as an inventory. This is not going to be classified as IAS 40. A property being constructed for a customer, obviously the property which is constructed for a customer as well, this is not going to be regarded as an investment property because you are constructing it for another customer. This is again going to be classified as your inventory. A property held by build company as a right of use asset and leased out under a 6-month lease. Now, a property held by build company as a right of use asset and leased out under a 6-month lease. You have a property which you have got under a right of use asset, right? You have got the property under the lease and then you have rented it out as well. You got the property under the lease and then you have rented out as well. So this is where you are getting the rental. You are getting the rental income. So this is going to be classified as investment property because you are earning the rentals. You are earning the rentals. So this is going to be classified as property, and a property owned by company and leased out to subsidiary. Now look here at this point. A property owned by the property is in the guys, are you able? Guys, can you hear me properly now?
Yes.
Okay. I don't know why the internet has started being the problem again. Okay, so we were talking about a property owned by build company and leased out to subsidiary. In individual accounts, if we talk about this is definitely for sure investment property if we talk about individual accounts. But as far as the consolidation is concerned, this cannot be recorded or regarded as investment property, because into the consolidation accounts or in the consolidated accounts we have to eliminate the intercompany balances done. So the option is going to be option C: a property held by a build company as a right of use asset and leased out under a 6 months lease. Now question 28, again related to the investment property, and talking about this, we have to talk about which of the statements are true and which are basically false. And following initial recognition, investment property can be held at either cost or fair value. Yes, after initial recognition, we have the choice either to record it at the cost or at the fair value. We have the option to record it. So definitely for sure, this is true. So this is going to be true. Then we have, if an investment property is held at fair value, this must be applied to all entities investment property. Yes, true. This is something we have seen as far as the IS 16's fair value model is concerned as well, that if we apply our specific model to a specific class, that then that entire class is going to use that specific model. For example, if we are using the fair value model for the investment property, then all of the investment properties have to be revalued using the fair value model. It's not that we can only apply one specific model to one single asset or something. Then an investment property is initially measured at cost, including the transaction cost. Yes. Investment property is obviously initially measured at cost, including the transaction cost. For example, the surveyors, the architect fee, along with the lawyers and all of the costs have to be included into the transaction costs. It's true. Then a gain or loss arising from a change in the fair value of an investment property should be recognized in the revaluation surplus. Subsidizing. This is wrong. This is false. Why? Because the gain or the loss arising on the investment property is recorded into the statement of comprehensive income. It's not recorded into the revaluation surplus. Had it been the gain on the revaluation of a non-current asset as a tangible non-current asset held under IAS 16, then it would have been true. It would have been correct. But the gain or loss on the revaluation of an investment property is recorded in income statement, not in the revaluation surplus, but in the income statement. So this is false. Done. I hope it's clear to you guys. Then the question 29 we have already done. Then we have this question 30. Okay, let's see this question. Whether my company purchased a machine on 1st July 20x7 for 500,000, it is being depreciated on a straight line basis over its useful life of 10 years. A residual value is estimated at 20,000. On 1st January 20x8, following a change in legislation, whereby company fitted a safety guard to the machine. The safety guard cost 25,000 and has a useful life of 5 years with no residual value. What amount will be charged on the profit and loss for the year ended 31st March 2008 in respect of the depreciation on this machine? Now, this is a question related to a non-current asset where we are applying a concept of component accounting. This is a question related to a non-current asset where basically we are applying the concept of the component accounting. Okay, let me share my Excel. The component accounting concept is let me just brief you with the concept, and then we will go towards solving the question as far as the question is concerned. The component accounting is basically a combination of multiple assets, individual assets, which are combined together to form one single asset, right? And that is called as a complex asset. And in the case of a complex asset, we have to go as far as applying the concept of a component accounting is, because over there the multiple assets, they all have their individual useful life, they have different useful life, and the problem arises when we are calculating the depreciation on such an asset. When we are calculating the depreciation on such an asset, the problem arises. So that's why we have to apply the concept of component accounting. For example, we have an aeroplane with us, and assumingly the cost is 100,000. Now, if we see the breakup, we see it has the body, it has the interior, it has the engines. The body has a useful life of 20 years, the interior has a useful life of 10 years, engines have a useful life of 5 years, right? These are the three components of an aeroplane. Now, the question comes, after 1 year, if we have to calculate the depreciation on this aeroplane, how should we calculate the depreciation? Over the 20 years, over the 10 years or over the 5 years. This is a problem now of this complex asset. That is total value is 100,000, but the components of it has individual different useful life. The body has a life of 20 years, the interior has a life of 10 years, the engines have a life of 5 years. So the question comes, how should we depreciate it? Either on the 20 years, either on the 10 years, or either on the 5 years. When we ask this question, the answer is given to us that in order to calculate the depreciation, you have to see that what is the breakup of this 100,000. Now, we see that 25,000 is for the engines. We see 50,000 is for the body and 25,000 is for the interior. Now the total is standing at 100,000. Now how to depreciate? Simply divide each component according to its relevant useful life. Divide each component according to its relevant useful life. For example, 50,000 by 20. For example, 25,000 by 10. For example, 25,000 by 5. You get a total depreciation charge of 10,000. You get a total depreciation charge on the aeroplane or airplane as 10,000. This is how you are going to apply the concept of component accounting, or this is what the concept of component accounting is. And this same concept is applied over here in this question, where on 1st July, we got the machine for 500,000. Life is 10 years. Residual value is 20,000. So technically, current year or annual depreciation is 48,000. So the annual depreciation is basically 48,000 per year over here. Done. Now the question comes that how do we basically takes up the depreciation? Now we got the machine on 1st July 20x7, and the useful life is 10 years. Residual value is 20,000. On 1st January, there was a change in legislation where we have to apply a safety guard to the machine. The cost is 25,000 and the life of it is for 5 years. Year end is 31st March. How to calculate the depreciation on the machine? How you are going to calculate? You are going to take up the machine first. The annual depreciation for this is 48,000. Done. This is annual. So divided by 12 into from January to July 20x7 till March 20x8. How many months have passed? Till July, from July till March is 9 months. So we are going to have with 9 months. That divided by 12 into 9. And then we have this safety guard with us. This is 25,000 by 5 into the life is basically 5 years now. So from January till March, we are going to have 3 by 12. So this is 48,000 into 9 by 12. Then we have 25,000 by 5 into 3 by 12. We have 1250. Done. So we have a total of 37250. This is going to be the answer. Okay, this is a fill in the blank. So our answer is going to be 37250. I hope it's clear to you. Then basically what we did, we charged a separate depreciation on the machine. We charged a separate depreciation on the on the safety guard. Done. Then we have question 31. Auckland company purchased a machine for 60,000 first January 20X7 and assigned it a useful life of 15 years. On 31st March 20X9, it was revalued to 64,000 with no change in useful life. Now, what will be the depreciation charge in relation to this machine in the financial statements of Auckland Company for the year ending 31st December 20X9? This is the question related to the fair value as well, and I guess this is the question which we have already discussed in the class, but let's just check it again. Let's just check it again for now. Let's just do this question again. Let's just go back to our Excel. Okay. So we got the machine on 1st January, life is 15 years, and on 31st March 20X9, it is revalued. Our year end is 31st December 20X9. Now, what's the rule? The rule for calculating the revaluation gain and all is to basically have the carrying value of the asset at exactly the same date on which the fair value is given, right? In this case, if we look over here, this is the cost, this is the life, and this is the time when the revaluation is taking place. So let's just calculate. First of all, depreciation, all right, accumulated depreciation on machine. We have 60,000 minus, not minus, we don't have any scrap value, just divided with 15. So we have annual depreciation of 4,000. This is annual depreciation done. Now, how much time has been passed? 2 years and 3 months. 2 years, 3 months. And then for 3 months, we have we have 1,000. So the total depreciation charge or accumulated depreciation is 9,000 on the asset. Accumulated depreciation on the asset so far is 9,000. Done? I hope it's clear to you. Moving ahead from here, what will be the depreciation charge in relation to this machine in the financial statements of Auckland Company for the year ending 31st December 2009? Okay, it has been revalued to 64,000 with no change in life. So total depreciation charge for the year ended December 20X9. 3 months prior to revaluation. 3 months prior to revaluation, if we talk about, we have 1,000 done. Then a revalued amount depreciation is at 64,000 divided by remaining life. We had a total life of 15 years, from which 2 years and 3 months have passed. 2 years and 3 months have passed. Done. So now what we are going to do is we are going to calculate the life which we have at hand with us. This is 15 years total, 2 years, 3 months passed, and remaining is 12 months and, sorry, 12 years and 9 months. So we can say 9 by 12 as 0.75. So technically speaking, what we are going to do now is, this is going to be 64,000 divided by 12.75 into 9 by 12. Actually, I had to figure out the 9 months as into the context of the number of years, which I did over here. So this is 64,000 by 12.75 into 9 by 12. I have 3765. Done. So the total is now going to be 4765. Done. The total is now going to be at 4765, and this 4765 is the total depreciation charge for the year. Okay, this is again fill in the blanks. You are going to write 4765. Okay, moving ahead from here, we have question 32, and it is, car company vacated its head office building and let it out to third party on 30th June 2008. The building had an original cost of 900,000 on 1st January 2080 and was being depreciated over 50 years. It was judged to have a fair value on 30th June 2008 of 950,000. At the year end, date of 31st December 2008, the fair value of the building was estimated at 1.2 million. Carter Company uses the fair value model for investment property. What amount will be shown in the revaluation surplus at 31st December 2008 in respect of the building? Now, let's just go to the Excel after copying this question. Okay. Now, talking about this question, what should be the approach? We have to see, we let out the property on 30th June, right? And it was a head office building. So technically speaking, before letting out to third parties, it was used as an asset under personal use. So technically speaking, this would have been classified under IAS 16. Done. So at 30th June, the value was at 950, right? So technically speaking, this revaluation or the difference of this is going to be classified as a revaluation surplus, because the rule of the investment property, at the recognition is that whenever there is a transfer between the class of the asset, it has to be done at the fair value. So at first, the property was classified as IS 16, tangible non-current asset. So the revaluation on it is going to be recorded in the revaluation reserve. Done. So that is going to be recorded as a revaluation reserve. So that is going to be recorded into the revaluation reserve. So let's go over there and check how it is going to be done. We have the cost on 1st January, 900,000. Done. Life, 50 years. And then we had a fair value on 30th June 20x8. Okay. So from January 20x0 to 20x8, we have 20x0, x1, x2, x3, x4, x5, x6, x7, right? x7, 8.5 years, and then x8 till June. Na? So 8.5 years have passed. 900,000 by 50 into 8.5. This is going to be our accumulated depreciation. We have 153. So the carrying, oops, the carrying value is at 747, and now the fair value is 950. So the revaluation gain is this minus this 203,000. This 203,000 is the answer, because this is a gain which has to be shown into the revaluation surplus. Okay, this is again fill in the blank, so you're going to simply write it over here. Okay, one more thing I wanted to show you over here is this has been revalued to 950,000 done. And then it says at the year end of 31st December 2028, the fair value of the building was estimated at 1.2 million. Now, fair value at year end. This is at 1.2 million. Done. This is the fair value at 30th June. So the difference is 250,000. This 250,000 is going to be recorded as a gain on investment property in income statement. This is the gain on investment which is going to be recorded into the income statement as what do we call it as, into the income statement as a gain on investment. This is going to be recorded as a gain on investment. I hope it's clear to you. Done. This is a gain on investment property and it is going to be recorded in the income statement. Done. I hope it's clear to you. Okay, moving out from here, as far as the section A type questions are concerned, these are kind of been solved and been cleared by us. Now let me just go to the other questions which I want to discuss with you. Okay. So these are the section B type questions. This is a plethora company. For now, we are not going to do the plethora company. We have this daring over here. Yeah. Let's do this daring question first. Let me just copy the question from here and let me just go to the Excel. Okay. Why my Excel is not responding? Okay. Okay. So here's the question. On 1st October 2025, Daring Company acquired a machine under the following terms. This is the cost, this is a trade discount, this is the freight charges, electric installation, staff training, pre-production testing, purchase of a 3-year maintenance contract. And on 1st October 2027, Daring Company decided to upgrade the machine by adding new components at a cost of 200,000. This upgrade led to a reduction in the production time per unit of the goods being manufactured using the machine. So this is the information which is available to us. And now let's just talk about what we are going to do here. Guys, hold on for a second, please. Okay. So we were talking about this daring question. Now we have question 52 with us. And why my laptop is not responding? Guys, am I sharing the Excel or the my exam kit? Because my laptop is kind of stuck over here, and I am unable to toggle. Okay, I have the Excel. Okay, I'm unable to toggle between via the Zoom. So I'm just toggling here and there, and I just don't know. I mean, what's happening? I mean, just give me a second. I don't know why it had started to give them the errors. Anyhow, now where's the question? Okay, yeah, it's here. Okay, so this is the daring question we were talking. Yeah, daring company. The question number 52 is basically what amount should be recognized under the non-current assets as the cost of the machine. As a cost of the machine, we have to talk about that. What should be the amount? So this is question 52. Cost of the machine. And we are going to solve this. First of all, we have the cost at 1050 done, and then we have a trade discount over here as well. So we are going to write the cost, then we have the trade discount 20%, this into 0.2. 210 is going to be the trade discount, which we are going to deduct from here. Done. And this is going to be, after deduction, 840,000. Then we have the freight charges. These are going to be capitalized, obviously. This is for 30,000. Then we have electrical installation. Electrical installation is for 28,000. It will be capitalized. Staff training cost is not capitalized because it doesn't meet the criteria of the asset. Then we have pre-production testing. Yeah. This is the first testing cost. It will be capitalized. Pre-production testing at 22,000. This will be capitalized as well. Done. So technically speaking, the total cost which will be capitalized will be 920,000. The total cost that will be capitalized will be 920,000. The purchase of a 3-year maintenance contract. We have purchased a 3-year maintenance contract as well. We do not capitalize the maintenance contract because this is a maintenance cost. This is not the cost of an asset, right? This is a cost which we are incurring as far as maintaining the asset is concerned. So this is something which cannot be capitalized into the cost of the asset. I hope it's clear to you guys. Let me just try to share the exam kit again. Okay. So the answer was 920,000, option B. Okay. Now the question says 53, how should the 200,000 worth of new components be accounted for? We have the new components that we bought on 1st October. Now we have to tell that how to account for these new components. Now, we have studied the IAS 16 in which we talked about subsequent expenditure. We have studied the IAS 16 in which we happen to talk about the subsequent expenditure. And in the subsequent expenditure, what did we learn? That any cost that enhances the performance or increases the useful life of an asset, that enhances the performance or increases the useful life of the asset is capitalized. Any expense that is incurred on the non-current asset which enhances its useful life, or sorry, which enhances its performance or increases its useful life, they are added to the cost of the asset, or they are added to the carrying value of the asset. So the answer is going to be A, added to the carrying amount of the machine. Option B is charged to profit and loss. No, it has to be capitalized. Capitalized as a separate asset. We cannot capitalize it as a separate asset because this is an expense incurred on the asset that we already have. This is an expense which is incurred on the asset which we already have. So we cannot capitalize it as a separate asset and then debit it to accumulated depreciation. What's the point of debiting the accumulated depreciation? It's not a revaluation or something, right? It's not a revaluation. Now, question 54. Every 5 years, the machine will need a major overhaul in order to keep running. How should this be accounted for? Every 5 years, you need to have an overhaul of the machine in order to keep the machine running. And we have to talk about that. Set up the provision at year 1. Provision from your prior studies. What's the provision? Any idea? From your prior studies, you guys must be knowing about the provision. Anyone? No one? Any idea about what the provision is? Any idea about what the provision is? Guys, anyone? I'm waiting. Providing an amount for future use? No. It's not an amount to be provided for the future use or something. Okay. What's the definition of a provision? A liability of uncertain timing and amount, right? If we talk about the literal definition about the provision is basically a liability of uncertain timing and amount, it's called provision, right? A liability of uncertain timing and amount, it's called provision. And when I give it the word as a provision, sorry, if I give it a word as a liability of uncertain timing and amount, na? Liability, what's the definition of liability? A present obligation arising from some past event. A present obligation arising from some past event. Now, a present obligation arising from some past event means a liability is something which is created out of a past event. Now, look here. We need to do the major overhauling every 5 years. That is an expense that is to be incurred into the future. And it has nothing to do with the past. It has nothing to do with the past. So, technically speaking, we cannot record the provision of a future event. I mean, it's totally up to the company to decide about either to do the overhauling or not. If it is planning to use the asset for the coming 5 years, there can be a possibility that the company might decide that it is not going to use the asset. Then what? There is a possibility that the company, may decide about not using, the asset in the future. Then what? Then what? If the company decides that it is not planning to use the asset in the future, then what you are going to do, or how you are basically going to account for it. Then see, got my point? So this is something that you have to see, and you have to judge about. Okay, this is something that you have to see, or this is something you have to judge about, while accounting for it. Okay, and then we have built up a provision over the year 1 and 5. Again, this is the same. We cannot build up a provision over here. We cannot build up a provision because the provision has to be related to the past event and it's a future event, so we cannot build up a provision. Then capitalize the cost when it arises and amortize over 5 years, right? Capitalize the cost when it arises and amortize over 5 years. So technically speaking, capitalizing the cost, when it arises and amortize over 5 years, this is logically going to be the answer. We have to capitalize the cost when they arise, and we are going to then amortize it over the 5 years. So technically, this is the cost which is relating to the coming 5 years now. So when we incur the cost, we are going to capitalize it, and we are going to capitalize it over the 5 years. Done. This is how it is going to be recorded. And then write the overall to the maintenance cost. No, we don't charge the overall cost to the as a maintenance cost as an expense to the income statement. Done. We don't charge these as a cost to the income statement. Okay, so this is not how it is going to be recorded. Okay, I hope it's clear to you guys. And then we have a question relating to the impairments, and this is the standard. This is related to the IS 36 impairment of assets. We are yet to do this standard, so we are not going to do this MCQ for now. And then it says again, this is in payment review. We are not going to do that. Okay, now we have this question of the elite leisure company. And how about if you guys try this? How about if you guys try this question? And this is something I will be discussing in our next class with you. Okay, try this question. And if you are unable to do it or something, then we will definitely going to discuss it in our next class. And in the next week onwards, I am going to I'm planning basically to change the timings of the class by maximum half an hour, because it's been like kind of 2.5 hours now, and I am planning to increase the class timing to 3 hours. So is it possible for you guys to join 30 minutes early? I mean, if I, according to your local time, I guess your class started at 7, right? If I am not wrong, your class, according to the Mauritius time, it started today at 7, right? So is it possible for you guys to join the class at 6:30 of your time? Okay, Miss Furushi is saying it's okay. Okay, Miss. Okay, I was saying is yes. Love is saying okay. And what about the other ones? Ashad, is it okay for you to join at 6:30? Okay, Miss Sophie, don't have the BPP kit. Okay, I am sending the BPP kit right now, and I am sending it onto the Zoom right now straight away. Books. I'm sending the exam kit to you. Kindly accept it to all of you. Okay, I send it to Miss Sophie only. Other ones, everyone else, do they have the exam kit? Okay, Miss Furushi has. Okay, Love, she don't have. Let me send it to all of you. The ones who don't have, they can have this exam kit. Okay, so this is going to be all from my side for today. I've given you this question of the elite ledger from 57 to 61. You guys are supposed to solve it, try to solve it. And obviously, if you are unable to or something, then obviously I'm going to guide the whole question to you. I'm going to solve it for you guys. And next time when we meet, we are going to talk about some of the new standards, like, via following which we will be able to do our exam kit practice as well. So till next Friday, it's bye bye from my side. Take very good care of yourself, and enjoy the weekend as well and the whole week ahead of you as well. Try to revise what studied